on behalf of the London Shipping Law Centre and Stephenson Harwood to what is the third in a series of events on the Strait of Hormuz. Given the ever-shifting pattern of events in the Gulf, it's too early to tell whether this is the third and last or whether it is merely the latest instalment of an ongoing series. That shifting pattern has also made our collective preparations for this session something like nailing jelly to a wall. But whilst the precise content has been adapted as preparations have gone on over the recent weeks, we have managed at least to stick to the three topics as initially advertised, albeit with one slight change. It was originally running the gauntlet, but now not really a gauntlet to be run, technically speaking, so it's now merely the current position. But these are the three topics we're going to be covering today. So how has the situation evolved regarding vessels transiting the Strait of Hormuz, and what are the key practical and legal considerations for traders and charterers? Managing price risk, a comparison of the effects of the crisis on crude oil and the fertiliser markets, which are, as most people will know, I'm sure, two of the commodities classes that have been most affected by the circumstances in the Gulf. And then finally, Mercuria versus the Baltic Exchange. So we're going to take a look at this case, which is really the most significant and the highest profile dispute to have risen from the crisis so far. Now, each of these topics could justify a couple of hours on their own. So we're not going to be able to cover everything. And where we do cover stuff, it's obviously not going to be in as much detail as could be the case. But I am nonetheless sure that we will do justice to these different topics, especially in view of the quality of the panel that we have here today. Starting from your right, my left, we have Rebecca Crookenden, who's one of my partners here at SH, whose practice covers both commodity trading and shipping matters. We then have Catherine Jago, who is someone who probably doesn't need much introduction to anybody who has dealt with an oil trading dispute before. Catherine brings several decades worth of experience on the oil industry, and today is going to provide a commercial perspective on crude oil in the Gulf. Then we have Ed Turner, who brings himself a couple of decades of experience as a private practice lawyer, but is here today in his capacity as Global Claims Director of the MECO Group, MECO having been his home for the past 15 years or thereabouts. And Ed is bringing a marine insurance perspective or angle, particularly from a charterer's perspective. And I'm reliably told we have online Dhruv Puri, who is a trading manager at Ameropa, who specializes in fertiliser markets, particularly urea and sulfur. At the outset, I would like to give a special thanks to Dhruv because he is in Singapore and has stayed up late, especially to provide his insights. Before we move on to the panel discussion itself, I just want to set the scene with a recap of events in recent days. There's no guarantee that this is up to date because I did this at least 3 hours ago. So things may have changed. So feel free to shout at me if I've missed something. But 17th of June, the US and Iran signed a 14-point MOU, which included an, in inverted commas, immediate and permanent termination of military operations on all fronts. As part of the MOU, Iran had agreed to use its best efforts for the safe passage of commercial vessels with no charge for 60 days. That ceasefire, or the ceasefire brought about by the MOU, has been under threat because of renewed attacks by both sides. Last Thursday, 25th of June, an Iranian projectile hit a cargo ship in the Strait on the passes on the Omani side, I believe. And then over the weekend, the US retaliated with a series of strikes on Iran, and Iran responded in kind with strikes on US bases in Kuwait and Bahrain, although the US said they didn't land or didn't do very much. Then alongside this, on Friday, the US mediated the signing of a framework agreement between Israel and Lebanon. That was promptly condemned by the leader of Hezbollah On Sunday, 2 days after the agreement was signed, Israel struck southern Lebanon. And of course, as has always been the case throughout this, Iran says that the resolution of hostilities between Israel and Lebanon is crucial to and a precondition to a lasting peace. As of this morning, the US confirmed, but I'm not sure that Iran has confirmed, that Iran and the US have agreed to stand down following their exchanges of strikes, and there may or may not be further talks in Doha tomorrow. Who knows? With that summary, I'm going to switch positions and actually sit down rather than stand up for the next hour, and we can move on to section 1.
Thanks very much, Jonathan. Good evening, everybody. I'll be talking largely from a charterer's perspective, but hopefully sharing some insight in a lot of the cases that we've had, although in view of the shortage of time, perhaps just snippets. Following on from what Jonathan said, the intriguing, if not to say curious, position of the Americans is that the Iranians had requested the Doha meeting tomorrow, whereas the Iranian position is that they have nothing scheduled and know nothing about it. So in some ways that, for want of a better word, is illustrative of the fluidity and the uncertainty of the world that we live in. The evolving situation is how has it evolved? Perhaps with your blessing, I'll just say a few words in relation to the Straits of Hormuz specifically. To my mind, and perhaps many of those in the audience tonight, the question is not so much were the straits ever closed, but much more what was the risk profile of those who were able to cross the strait? Because clearly vessels were crossing the strait right really from the word go, and having looked at some interesting statistics right throughout, there were in fact crossings. So what we'll hint at today in the time available is the risk profile, the exposure and obviously third-party liability to those who were crossing the straits, and more particularly the loss of time that was experienced by with all of the developments and negotiations in relation to whether not to cross the strait. We've had at the Charterers P&I Club, as you can imagine, a lot in the first period, and given that we are talking about how matters have evolved, I'll give you perhaps a flavour of some of those disputes at the outset. I'll start perhaps with a couple of voyage charter examples and then turn to a time charter. But before I do, may I say this? It seems to me that the current disputes and the issues arising are all about the entirely changed environment that we'll come on to see that the clauses and to some extent the authorities don't really properly rehearse. We're in an environment where the parties are sharing the consequences of the changing risk environment. And we have seen a lot of ad hoc deal and compromise of vessels that were in the AG, which I'll come on to. Following my mini roadmap, a couple of voyage charter examples just to kick off were these. We had a couple of ships that were loading cargo and the load port was struck, and continuing the theme of loss of time and expenses, which is obviously a big theme in from a legal perspective in all of this. The vessel was ordered off port, part laden by the owners, and there she stayed at the anchorage for a period, in one case, for a very, very extended period. And the question arose, perhaps a prosaic question for us shipping lawyers, but who assumes the responsibility for the loss of time? Obviously, with the vessel having moved off port, and with the danger, or the perceived danger from an owner's perspective, being going back into port, their position was that they were required to do this for their own safety, and they should be rewarded, at least in detention, for their loss of time and for the costs associated. In fact, one of the cases was more straightforward because the vessel and the owners then instructed the vessel, part laden, to sail and issue bills of lading in relation to that part loaded cargo. So following along the sort of trite lines of Budget and Billington and those authorities where the owners kind of take it into their own hands, obviously they couldn't pay, they couldn't claim laytime and demurrage, and detention wasn't obviously payable at all, if at all, because they had made the decision to sail on. It gives you a flavour. And another one where we've had a lot of delay, and we'll come on to con wartime and voy wartime a little bit later, but is in relation to ships approaching the Gulf, where the voy war clause is triggered. And depending obviously on which version we're using, but typically it's the older one, the 13 rather than the 25, in which case 48 hours, as we know, are afforded to the charterer to declare an alternative discharge port, absent them, the owners say, safely being able to navigate to the intended port within the Gulf. And then again, who pays for the loss of time and the expenses? So everyone will, many of us will remember that the wording, the choice wording on the voy war clause is this: that if the charterer doesn't within the 48 hours elect on a new discharge port, then the owners may take steps to ensure that the vessel, that the cargo is discharged in a safe place. But that's inexact wording, and the word may, because of course one needs to look beneath the veneer. If the vessel's going to go to somewhere totally different, bills of lading have obviously been issued or in circulation. The receiver won't want to receive, and we've had a lot of cases where cargoes have been abandoned because the receiver didn't want to receive the cargo anywhere near where the charterer eventually ordered following the voy war declaration. And then obviously there's the expense of housing the cargo. So what should happen in these circumstances? Recently, as some of us will know, that a tribunal ruling held this, that there should be an implied term on the charterer, if not within the 48 hours, if it's clear that the owner didn't intend seriously under the word may to then move quickly, that detention should be payable mid-passage, because ultimately in a risk allocation or apportionment analysis, which is obviously what we all do in this room, allocating a risk, the proper party to have inherited the risk of delay is the charterer, the poor beleaguered charterer. Now, the charterer is no doubt facing considerable difficulties liaising with those further down the chain, or very properly, if, for example, if they're the CFR CIF seller with the receiver, and that takes a lot of time. But now, apparently, according to a recent London arbitration decision, that charterer is liable in detention for a potentially extended period while the discussions are on foot. So we'll come on to more of this stuff later when we look at perhaps how the voy war and con war time clauses no longer reflect the reality of conditions on the ground as we're seeing them, dynamically. And so I'll park that at that point because we will be coming back to it. We've seen some very curious cases in relation to time charters, and I say very curious because some of the arguments run by the owners, for example, on redelivery obligations, have been interesting to chart. I mean, as we all know, or many of us know in this room, whereas an owner can resist redelivery if it's early and can hold charterers to the contract, aqua faith and all that, the charterer can purport to redeliver or can redeliver in the wrong place as long as it's not early, and face the prospect of damages to be assessed with obviously the difference between what the owner would have enjoyed against the expenses of them enjoying it on redelivery to the proper discharge port. But we've seen, in that theme, we've seen a lot of very interesting and creative arguments run by the owners, including, for example, that they should be recompensed, notwithstanding that it was they themselves who refused to sail to the proper discharge port, that they should be entitled to damages. And the owners have often struggled to show that the loss was proper. And in fact, very possibly, very arguably, the owners were benefited by the ad hoc variation by the charterers redelivering the vessel outside the Gulf, because they were then in a better position to be able to trade in places like Corsica and Fujairah. Many of these, if you'll allow me to say, I mean, the sort of satellites just outside the Gulf, which in principle can allow for a safe redelivery and not to an unsafe port. But so we've seen a lot of interesting and creative arguments. But just to conclude on just giving you a flavour, I mean, I can't take too much time, and I'll pass over to Rebecca. It seems to me that the key issues are these. Applying the words of the question, what is it that charterers need to do? What are the practical and legal considerations? It seems to me that we're in an environment where charterers will be increasingly highly circumspect about whether they're able to proceed within the AG, within the Gulf, or from outside the Gulf. For example, they'll be waiting offshore for extended periods. They'll be awaiting updated intelligence from authorities, or depending on, as we've seen overnight, dynamic developments. And this is the world that we're in. And a lot of the clauses, as we'll come on to see, don't deal with this, and yet these are the issues before us, including such things as the secondary consequences of deviation, because we talked about redelivery, but a lot of vessels have obviously been routinely deviating, both within the Gulf because of dangers within the Gulf, and actually obviously avoiding the Gulf. We have seen a lot of creative arrangements. I mean, a lot of our assureds have been chartering in just then staying within the Gulf to fix ad hoc, rather than, obviously, to use the previous words, running the gauntlet of getting out of the Straits of Hormuz. But even that has been fraught sometimes in relation to some of the ports dynamically becoming unsafe, literally overnight. So the environment and the current disputes that we're seeing and the way forward for charterers is going to be result in a lot of consideration of wordings and clauses in charter parties and in contracts generally, to account for this new environment, this dynamic, evolving environment, and a willingness, I think, to potentially to work with owners to share the consequences of the new risk environment. That's what I'd like to begin by saying.
I think now might be a chance to pass over to Rebecca. Particularly, you were just touching on disputes and how how those are evolving. So just wondering, Rebecca, maybe there's something about the situation as it looks right now, for vessels going in and out, and the key obstacles and kind of how we're seeing disputes evolve and emerge. Maybe you could touch on that, please.
I think the main thing is that the vessels are going in and out. I know the first two sessions that were run by the LSLC, that was far from given, although there are the sort of rumours of people going in and out of the Strait of the Gulf at all times. I think it now, particularly with the most recent cessation of hostilities, albeit potentially temporary, does seem to have led to increased traffic, and most of the vessels we understand that had previously been stuck seem to have been able to leave, and there are also vessels that are going into the Gulf and on sort of fresh trays. So disputes that we saw previously had been urgent, real time, and sort of focused on how to solve the immediate practical issues, be that declaring FM, someone coming up against their contractual counterparty failing to nominate a performing vessel, failing to take delivery of a cargo, whether a deviation is possible either under the war risks clause that Ed just touched on, or potentially once a cargo has been loaded under the liberties clauses in the bills of lading, how you allocate any of those additional costs. Though all of those are very sort of real time and urgent, and have now matured as the parties have either found a commercial solution between them as the situation was ongoing, or have had parked the disputes in the hopes that their commercial relationship could keep going. So now that we're in a slightly more level position, we would expect to see those, and we are seeing those losses crystallize, and the parties then making an election. Is this a commercial relationship that I want to maintain? Is the loss so great that I have to start formal proceedings where the scale requires it, and I can sort of make the commercial relationship secondary to that? There's also the question of frustration. Again, highly fact specific, as I think every single talk on Hormuz has touched on. But now that there is hopefully in sight at least a sort of an end point to the current situation, even if the new situation, as we'll go on to, is not necessarily back to how we were before, it is probably a time at which parties will be able to assess whether or not they'll be able to run a claim in frustration. That's largely going to be under a charter party, because where your sale contracts have an FM regime, it's unlikely that frustration will help you. Aside from the question of whether you're able to run an argument of frustration, one of the key points that is unable at the moment, as we understand it, it's very hard to point to a specific date. You need to have a point in time at which the contract became frustrated, and it's hard to tell at which point that came, even if you were able to tell using, for example, a sort of a CTL equivalent limit. And I know some parties who were dealing with issues in the Russia-Ukraine conflict where they were stuck in ports. You can use that 12-month marker point as a sort of an indicator of when your contract might be frustrated. We don't have a similar marker here, and so that is an ongoing question, and it remains to be seen if anyone will successfully argue frustration. There are some practical issues as well, such as the availability of bunkers, the inability to test any bunkers that were stemmed from various different ports, that crew changes that should now have been more or less resolved. But again, these are going to lead to additional losses that will now crystallize, and parties will be able to assess whether or not that's something that they want to stomach, or if they can actually make a claim, and if they want to make a claim.
So I have now what is probably recognizable to everyone in the room as something of a leading question. If the current ceasefire holds and the MOU results in some kind of lasting settlement, does this mean that things will go back to normal? Ed, maybe you could touch on that one first, although you've telegraphed a little bit of it on the way.
Forgive me if I have. 2 days after the MOU was signed in Islamabad, the Persian Gulf Strait Authority issued this document, which I think everybody is, or most of us will be familiar with. Suffice to say, this document says my way or the highway, sorry, forgive my colloquialism, in relation to the Straits of Hormuz. And it seems, it's in some ways, it's a curious way of dealing, isn't it? You reach on the face of it, a pretty favorable settlement, as I think we'd all say the Iranians did in the Islamabad MOU. And then they then purport to rehearse the future world, which is as soon as the 60 days of the MOU have expired, the access to Hormuz and frankly insurance to enable you to pass through Hormuz will be exclusively on our terms. That's to say, the insurance will need to be issued, obviously approved, but intriguingly issued by the Persian Gulf Strait Authority in order to pass through Hormuz. And I guess, in many ways we've seen a flavour of it, haven't we, in the intriguingly named Ever Lovely over the weekend, which was sailing quietly, you may say arguably sensibly, around the Omani coast, and was targeted for, frankly, passing the wrong way through the strait. So while we all would like to be sanguine about the world that we're going to live in going forward, I think these are pretty unequivocal messages being given by the Iranians as to the severity of their bargaining on Hormuz. The penny dropped, big time. Hormuz is their ultimate bargaining chip. And sadly, we obviously wait to see what happens in Doha tomorrow if the Iranians turn up. But sadly, we've got a pretty clear pointer as to the way events are likely to unfold. I don't know if anyone has anything to add to that, but
when I looked at the document, they seem to be asking for an awful lot of information as well, which from a commercial point of view could be seen as quite sensitive. I don't know if anyone else has opinions on that, but with a trader's hat on, I'd be quite reluctant to reveal some of that information.
Yes, no, that's it. Yeah. Rebecca, so I guess asking kind of the same question and maybe commenting on anything Catherine said if you want, but I wonder as well whether we wrap in a bit of discussion about this document. Yeah. So the two developments I think you can add some extra comments on, as well as the will things go back to normal, are on the one hand, we've got this suggestion, or rather, fairly clear indication that from an Iranian perspective at least, when this is all over, they will continue to control the strait and exact tolls or have this mandatory insurance in place. And then we also have on the US side the fact that in furtherance of the MOU, they've issued the general license to ease sanctions on the trade of Iranian crude and products. So as well as what's the new normal, what are the implications of those developments in terms of contractual compliance and any other kind of wider liabilities?
So I think addressing the PGSA documents first, I agree, it asks for a lot of information. It also doesn't currently ask for payment, but there is a general understanding that the PGSA and the IGRC are pretty linked. And notwithstanding the General License X, which does permit, does give us a waiver effectively of OFAC sanctions for dealing with oil and products, it doesn't exempt anyone from the sanctions that are in place for foreign terrorist organizations, of which the IGRC is one. And even dealing with them, notwithstanding any payments, not going back and forth, is arguably a breach of those OFAC sanctions. There's also the issue that the General License X is a general license, but it is only for those people who are exclusively subject to US sanctions. And the vast majority of people who we will be all dealing with every day are not only subject to US sanctions, they may be subject to EU, UK, UN sanctions. Increasingly, every single contract that surrounds a shipment of any specific cargo will have those sanction clauses in the sale contract. They'll have it in the charter party. They potentially will have it in, well, definitely will have it in their insurance contracts. And that all leads into whether or not the PGSA statement will render trade in and out of the Gulf effectively closed for the long term as well. There's also, to go back to the other point, just sort of what is the new normal? I think increasingly the contracts, the sale contracts and the charter parties are not really fit for purpose, because the situation, having war risks, which Ed will touch on, but the sort of the risk of war rather than war risk as a defined term was a sort of a relatively remote possibility before, albeit something that was contemplated. We've definitely seen some sale contracts that had Hormuz exclusions before, but they're pretty few and far between. It is now something, particularly with the knowledge that the Iranians have of what they hold as their ability to effectively shut down trade if they shut the strait. We may see more commonly parties looking to incorporate that sort of wording. Increasingly also, we think they'll probably look to the wording of their force majeure clauses, particularly if they've been stung in the past few months on not being able to rely on those clauses. You've then got the question of how the relative positions of the parties under a sale contract will deal with any sort of invocation of war risk. So if you take a CIF or a CFR contract, once shipped, your obligation as seller is at an end because you've delivered those goods under the sale contract, but you do have obligations as your charterer. And if the war risk clause is invoked, you've then got additional costs. You potentially have to stomach the cargo being discharged in a different port. You're not able to pass any additional any costs under your sale contract onto your buyer, and you can't interfere with the contract of carriage under your obligations, but under your charter party, you may be obliged to nominate an alternative port. So there is a tension between the relationship with owners and the receivers, this vessel owners and cargo receivers. So I think everyone will be looking at more closely at how they are able to protect themselves there. On the charter party side, we saw specific Hormuz clauses previously, but they were rare, and I think that's probably going to become almost a mandatory term for any party who's looking to protect themselves fully. And that's not necessarily to say that they're going to push responsibility onto their counterparty. It may be that they're formalizing a position that they may have come to in the sort of the negotiations that have happened over the last few months. For example, you're paying half hire if the vessel is waiting because the strait has been closed, or there are sudden warlike situations, or the risk has materially increased, or additional top-up rate if you're under a voyage charter. But Ed, do you want to touch on the
very briefly, because I think many in the room will know it. I mean, it's a very obvious point, isn't it? Void war and con war time were great in answering the straightforward, in dealing with the straightforward question: is it too dangerous? Is it dangerous enough? Let's frame it that way, to refuse to go. Sorry, I mean, I do discredit to the clauses. They also dealt with alternative routing and AP. Yes, so that's good. But it's very much that was then, this is now, because there's a whole raft of issues thrown up by the current conflict, which is going to lead to some interesting redrafting of clauses and potentially, albeit, of course, the BIMCO only renewed the clauses last year. But I mean, there's a whole, and arguably, why should they have in mind? But I mean, repeated reassessments of the vessel's positioning following governmental or military guidance, delays, waiting offshore, I mean, all these type of risks, and obviously the threats to the vessel systems is going to be something, I mean, a pretty invidious task really, to have to clause for the spoofing and hacking risks that we're seeing, sadly, fairly routinely. I think the majority of ships, for example, that passed out of the strait in the early days had all the systems turned off, and that's the reality of the world that we're in. So there's a lot there, and certainly the modern version should be, arguably, clauses, if not, the BIMCO rewrite, but at least the parties should be giving their minds to the effect of delays from official advisories, military rerouting recommendations. These are very practical issues, which, frankly, clauses have been silent on to date.
Thanks, Ed. I think we're ready to move on to section 2 or topic 2. Before we do so, I'm going to say something I should probably have said at the start, which is I think we're saving questions for the end rather than topic by topic, because we may find ourselves with insufficient time. So if everyone can save up your questions, write them down, memorize them, and ask them at the end. But on to the next topic of managing price risk. I was going to hand over to Catherine first, with the question for her being, what have we seen by way of trends in for Catherine's perspective, the crude markets as a result of the hostilities in the Gulf? And I think you may need me to find your slides.
I do indeed. And it's fascinating, really, because probably everyone in this room would have known where the Strait of Hormuz was before all of this happened, but now everyone knows where it is. This is very familiar to you all, but nevertheless, it's still quite useful to have it put in front of you. Just a few facts, as much as facts there are. This channel is only 21 miles wide. That is really narrow for the number of ships that are going backwards and forwards through it. And about a quarter of the world's seaborne oil, obviously some oil goes through pipelines or even by trucks, but a quarter of the world's seaborne oil and about a fifth of LNG would normally pass through this channel 21 miles wide. So this is why it's such a crucial place. In terms of oil and crude oil, roughly about 14 to 15 million barrels a day of oil production was unable to reach its market. To give you an idea, total demand, world demand for oil is roughly about 100 million barrels a day. So that's 14 to 15% of crude oil and products was unable to meet the market. And before the crisis, about 20 million barrels of crude oil and condensate normally transited through there. What is really interesting is, with respect to oil, there have been other ways in which the market has attempted to compensate for these losses. One of them was to look at some of the pipelines. Now, on here, and I do apologize, it's terribly small. Are the slides going to be sent out to people in due course? Well, if you want them, if you're that interested, I'm sure you can get it. But there were sort of 4 different pipelines that were considered as possibilities. But in reality, it was only 2 that were able to assist. One is the East-West crude oil pipeline for Saudi, which you can see there is the green one. That was being used, but it wasn't being used at full capacity. And there was about roughly 3 to 5 million barrels a day of spare capacity there that could be used. The other pipeline was in the UAE, and that's about 1.8 to 2 million barrels a day total capacity. And there was about another 0.7 million barrels a day of spare capacity there. The other 2 pipelines really had security constraints and just weren't alternatives. So it was those 2 that have been called into play, which means that there was potentially about roughly sort of 5 to 7 million barrels a day of additional pipeline that could be used to get oil out of the Persian Gulf into the market. There's also been a huge release of strategic stock. Now, the significance of that is in the wording. This is strategic stock that's there for a purpose. Yes, this was a good purpose for using it, but it's limited. About 400 million barrels were released, has been released over the period. Of that, the major amount was from the US. About 172 million barrels a day came from the US. That means that their level of strategic stock is less than 50% of what it's normally at. And it is very close to being at a minimum level. That means there's very little strategic stock left to compensate if we continue to have production shut in. There are potentially some more stockpiles that could be drawn down, particularly in countries such as Japan. But what's been happening is these countries have been closing in and saying, we're not going to let any of this oil out, we need it for ourselves. So in no way did the release of the strategic reserves fully compensate. And if you take the 400 million barrels that were released and simply do a mathematical calculation, it gives you roughly about 5 to 6 million barrels a day for 65 to 80 days. We are getting close to the end of that period when we can use that strategic stock. Apparently global inventories, so this is global now, not just the US, the Reuters reckon they've fallen by more than 1 billion barrels. That's a heck of a lot of reduction in strategic stocks. And really the message that I'm trying to get across is this can't go on. We can't continue to draw down on our strategic stocks. But having said that, the way that the oil price has responded has been modified by the ability to release some other stocks. And we also have, and some may say it's fortuitous, some may say it's pre-planned, the release of Venezuelan oil with respect to the reductions in the sanctions there. I'm not somebody that likes to stir things up, but who knows? It was very strategic that Trump went into Venezuela allegedly to save them, and the sanctions were changed. We could have Venezuela oil all of a sudden. So who knows? But the bottom line means that of the 14 to 15 million barrels a day, we've still got shut in about 10 to 12 million barrels a day of crude oil production. So what sort of impact has that had on prices? Well, if I could see...
Tell me when you need the slides.
I was just going to say, could I have the next slide, please, sir? Lovely, thank you. So when the war started, there was huge speculation about what prices were going to do. Bearing in mind that before the crisis started, crude oil prices were roughly about $75 to $80 a barrel. There was a lot of talk about it going up to $150, $200 a barrel. It's never quite made that. I think the highest that it's showing there is just under 110. This is a particular market. There are lots of markers, but you'll see that it peaked and then it came down and then it went up again. Huge volatility, but overall it hasn't gone as high as many people feared because of the reasons that I mentioned. There's been the ability to compensate for some of these losses. However, as you can see, there's huge volatility there. And if you take a cargo of, say, 1 million barrels, 2 million barrels, which is not unusual, $10 volatility on that, you're looking at losing 10 to 20 million dollars on one cargo. Huge price risk. That can be managed. And in due course, I'm going to just talk a little bit about how it can be managed through hedging tools, because I think it's very important that people understand that traders are not willing to run these sort of risks if there are tools that they can use. And in doing so, they are protected in some way against some of the losses which may be coming across some of your desks in the near future. I think that's what I wanted to say about the crude oil situation.
Thanks, Catherine. I mean, the thing that I think shone through there, and also our discussions leading up to this, is the extent to which the oil market has proved resilient and adaptable. And although prices have gone up, it hasn't been the horror story that was thought. I mean, there are limits to that resilience and adaptability with strategic stocks and everything else. But it is interesting that the worst fears that some had weren't confirmed. And I think that is kind of my segue into introducing Dhruv, who I hope will be online and visible shortly.
Yeah.
To ask the same the same question of the trends that we've seen this time in the fertiliser market as a result of the hostilities in the Gulf. I am your controller of the slides, so shout at me when you want them switched on. Moved on.
That's perfect. Can you hear me?
Yes, we can. Perfect.
Okay. Yeah, this is the right slide. So thanks, Jonathan. And also thank you, to the whole LSLC team for putting this together and having me here talk about the fertilizer industry. I'll just start off very quickly, with fertilizers as a primer. It's essentially nutrient for crops, and there are three main types of elements to the fertilizers. It's the nitrogen, phosphorus, and potash. But for the sake of this discussion today, I'll focus on two of these, which are the products most directly hit by the Strait of Hormuz situation. The first one is urea, which sits on the nitrogen side, and the second one is sulfur, which is a key raw material for the phosphate fertilizers. But before diving into these, I think it's worth highlighting a few common features to both these products, and also to sort of contrast with what Catherine just mentioned on the oil industry side. And the first one is, unlike the oil and gas industry, there's no pipelines for solid bulk commodities like urea or sulfur. And for instance, in a place like Saudi, like the map that Catherine just showed, moving product via trucks from, let's say, the east to the west coast across the desert simply isn't viable at scale. And in short, there's no real alternative route to the Strait of Hormuz. And the second point is, again, unlike oil, fertilizers don't really have a liquid paper market, or in most products, there's really no futures market available for hedging prices. And lastly, I'd like to highlight that over 50% of the global urea and sulfur trade is via long-term contracts between suppliers and buyers or traders. And if you zoom into just the Middle East, over 70% of the trade is under long-term contracts, which are typically 1 year long. Now, it matters enormously when the strait closes because of this. And maybe if you could help me put the next slide, Jonathan. Yeah, thanks. So yeah, starting off with urea, it's definitely the most traded nitrogen fertilizer in the world, about 50 to 55 million tons per year of trade. And it's the primary fertilizer for staple crops like rice, wheat, and vegetables. And on the map, you can see here on the right, the countries in green are urea exporters, and the ones in red are importers, for you to kind of visualize the trade flow. And since natural gas is, the main feedstock for fertilizers, most of the production tends to happen in the Middle East and Russia, and around 1/3 of the global urea supply comes from the Middle East, transiting the Hormuz. And given this, the impact of the war and the strait closure has been pretty severe on multiple levels. Firstly, at a direct production level, major producers like ones in Qatar are now running at close to 50% capacity due to the damage that they had on the factories. And on top of that, large urea importing nations like India, which get over 35% of its gas from a country like Qatar for India's own domestic urea plants, is also seeing its own internal production roughly halved. So you have a market that was already short of product, now facing a double whammy sort of a situation on the supply hit. And prices clearly reflect this. Since the strait's closure, the Arab Gulf prices, you can see here on the chart, roughly doubled in just 45 days. And we have seen similar looking spikes before, as I put on this chart, during COVID and at the start of the Russia-Ukraine war. but those were largely sentiment driven. This time, the fundamental supply is physically blocked or damaged with no real, timeline for sort of normalization. From mid-April, however, we did see, the prices of urea correct quite sharply, actually even below the pre-war levels. And this was mainly driven by two things recently. One was, the unaffordability, or rather the demand destruction and delay that we saw as a result of fertilizer prices doubling too fast, while the crop prices sort of remained flat. So the farm economics just didn't make sense for farmers to plant. Secondly, we saw the Chinese government step in and release a lot of supply to the market from China. So China emerged as an alternative source temporarily to the Middle East at very low prices. So that's the reason why the market really fell, in the last, let's say, couple of weeks. And many of the vessels, stuck in the strait that we saw were bound for long-term contract destinations that, like Thailand or a big market like India. So what happens next really depends on how quickly these vessels could transit the strait and reach these markets before their planting windows close. And also depends on how long, let's say, China keeps exporting at the current levels to fill in the gap that we see from the Middle East. Now, if you can move on to the next slide, which is the final one. On the phosphates, I'll focus more on its raw material, which is the sulfur. And the story here is arguably the most acute. Sulfur, is a byproduct of sour crude oil refining, which basically makes the supply very highly inelastic, because you simply can't produce more of it on demand or set up a new refinery. So end users for sulfur are primarily DAP phosphate fertilizer producers in Morocco and China, which are the ones mainly feeling the brunt of the situation there. And lately, sulfur has also been going as a raw material to the copper, nickel, and cobalt processors as well, even for the EV industry. So the closure of the strait had hit sulfur basically on three distinct levels. That's how I kind of classify it. And the first and most direct impact was that 60% of the global sulfur supply comes from the Middle East, and this was cut off overnight when the strait closed. And the second order effect is that the refineries in Southeast Asia and Mediterranean that hold, let's say, the long-term crude supply agreements with Middle Eastern producers, they aren't getting their crude, so they can't refine it to produce the sulfur. So the sulfur output dropped there as well. And on the third level, we see now governments realizing that the situation is dire, and countries like Turkey and Vietnam banned sulfur exports. China restricted sulfuric acid exports. And on top of this, in response to the Ukrainian drone attacks, let's say, on the Russian refineries, the Russians decided also to ban sulfur exports even before the strait had closed. So the price response was, of course, very dramatic, as you can imagine, because sulfur was already at elevated levels before the war due to this Russian sulfur ban. And post-closure, prices nearly tripled. And it's sustained at these high levels even until today. I mean, just for context, sulfur is a product, at least in my experience, I've usually seen trade at around $100 a ton. And at its peak earlier this month, we saw it almost at $1,500 a ton. So surprisingly, one of the driving industries was not really the fertilizers, but as I mentioned before, the mining and metal sector, because the copper processors in Africa or the nickel players in Indonesia can afford to pay higher premiums to get all the sulfur that there is, and which has pushed out many phosphate factories to shut down and curtail production due to the lack of sulfur. So just moving on to like a last topic that I had in mind is, why are sulfur still loading inside vessels still loading inside the strait? And I think this comes back to the point I mentioned earlier on long-term contracts, because refineries in the region, want the certainty that their sulfur, essentially a waste product for them, will continue to be lifted month after month. And with sulfur being such a hot commodity now, for most trading companies, these long-term contracts are critical, as there are dozens of traders lined up to take these away. And this is why, despite the risks, traders are making their calculated decision to keep loading vessels from inside the strait rather than forfeit contracts they've been building for years. Yes, I mean, just to wrap up, in essence, I just mentioned some of the points again. The supply disruptions this time are fundamentally different from anything we've seen in the recent years, which were more sentiment or fear driven. Secondly, the long-term contract structures drive the vessel movement a lot more independently to the day-to-day news, that evolves around the strait. And lastly, we're seeing many more vessels transiting the strait, as in the last weeks or so. But it's not exactly, I don't view it as an on-off switch in the strait. I think we're still operating in a gray zone where every stakeholder, be a trader, supplier, or buyer, is pretty much making a bet on a day-to-day basis on what comes next. What's clear, is that the scale of these disruptions this time is pretty unprecedented. And the knock-on effects, that we see, or rather we would see on crop inflation or food security, and even on EV supply chains, these are topics I think the broader shipping and legal community would need to watch closely as we move, into the next cropping cycles. So yeah, that's pretty much it from my side.
Thank you very much, Dhruv. I think the thing that really that really stands out for me there is that big distinction. You've got the same set of events, same sequence of events, but the impact that they have had on the crude market versus fertilizers, because of the different market dynamics and structure in a very, very different impact and a very strong point of comparison. And we may be coming on to another point of comparison,
yes, I think
which I think was for Dhruv first. But I think your response may be relatively short compared to what Catherine has to say on the topic, which, if you're a fertilizer trader sitting on a delayed cargo, be it urea or sulfur in the Gulf, what options do you actually have in terms of how you deal with it, and particularly on price risk? How do you manage that, if at all you can?
I mean, well, the honest and short answer is there's not that many options. Suppliers in the Middle East, they don't really release the traders from their contractual obligations to lift the product. So performance is essentially mandatory, and even more so for anyone, let's say, with a long-term contract or relationship that they'd want to protect. And unlike, in oil markets, which I'm sure Catherine would touch on later on, there's no real hedges available for fertilizers, waiting at the strait on a day-to-day basis. And what's happening in practice is, we see some traders getting a bit more creative. So one way to manage the exposure, what we see now lately is that, for instance, a trader would sit down and calculate every cost that they'd expect to incur from the war risk insurance, which have gone pretty high, the demurrage, retention, financing costs for, let's say, an assumed waiting period. Let's say this is 2 months, and they build all of this cost that they have into the price at which they want to sell to the buyer on a fixed spot price for 2 months. And if the vessel transits the strait faster than 2 months, they make a profit. And if it stays longer, they start to bleed on the costs that arise beyond the 2 months. And the key thing here, though, is that we see the payments from the buyers still being made against shipping documents once the vessel is loaded. So the traders are able to essentially cash in their LCs regardless of where the vessel actually sits. At least this protects the traders' cash flow and gives the buyers the comfort of knowing, that the vessel is loaded and reaches them the moment the strait opens. So this structure at least separates the payment risk, from the logistical risks, and it's pretty much the best you can do in this kind of environment as a fertilizer trader. But I think the broader structural outcome of this whole situation is that we're seeing a much bigger discount on the Middle East origin product versus products from alternative origins outside the strait. And this spread essentially reflects, the all-in cost and the risk premium, per se, let's say, of transiting the Strait of Hormuz. And it's being priced almost daily with the changing costs. So in a strange way, the market is still functioning, but it's just functioning at a higher cost and with far less predictability than anyone would like. So it's hard, to honestly manage this the price exposure from the fertilizer side.
Thank you very much. So same question to you, Catherine. Obviously, from a crude perspective, with a particular focus, I'm sure, on the management of price risk.
Yes, the oil market is different in that respect. Just before I talk about that, there's just one point that I wanted to make. When I was talking about the replacement crude that we were able to get into the market, either through pipelines or from stocks, the significant thing was that these have tended to be slightly sweeter crudes. In other words, they're not so sulfurous. And that's why there's less sulfur available for the fertilizer market. So the Far East refineries have taken and processed crude, but it's a different quality crude. All I was looking at were the absolute amounts of the crude oil, but I think that's an important point that feeds into the fertilizer. Yeah. So yes, I mean, this is a bit of my bête noire, and probably many of you have heard me talk about hedging, as I have been doing over the last 37 years, I think it is. This is not a new phenomena, managing price risk. It's something that every trader considers. They may choose not to do it, but in volatile markets, they will look very seriously about managing their price risk in some way. And I wonder if I could, you've got the slide up, excellent. So any of you who knows anything about hedging will know that this is a very, very simple example. But someone who will remain nameless, but is in this room and who I've talked to about hedging for many, many years, said, do you know, after I read that, Catherine, I could actually understand hedging. So I thought, yes, I've succeeded. Didn't I, Alika? So I'm giving you a very, very simple example here. So the risk that the trader is facing is that they load a cargo, and it often prices around loading, and they've got a cargo that's fixed price, but of course their sale price hasn't fixed yet. So let's take this very simple example here, where the trader buys a cargo at a benchmark price, say dated Brent, plus $2 a barrel. And they've sold it at the same benchmark, the dated Brent, plus $4 a barrel. So on the face of it, they're hoping they're going to make $2 a barrel. But the benchmark price that's used to calculate the absolute price is determined on different days. So in general, the purchase price may be around the loading dates, and the sale is around the delivery dates at the final discharge port. And as you can imagine, with what's been going on in the Middle East, these dates are likely to be very, very different in a very different market environment, as we saw in the graph that I showed earlier. Now, if the prices go up, which of course they have done a part of the time that we're looking at, the trader could make that market movement plus the $2. But if the prices fall, they could erode that expected profit and could result in a loss. And this is just too much of a risk for traders to face. So what they would do in this instance is they would sell a hedge. They would sell a paper product that they hope will move in tandem with the benchmark that they've used. If the market falls, then when their sale price comes to fix, they can make money by buying the hedge back, and that will compensate for some of the loss in the price of the physical cargo. If the market rises, they'll lose money on the hedge, but the trader's going to make more money on the physical. And in that way, he attempts to lock in his profit of the $2 a barrel. And that's really what hedging in the simplest of terms is all about. But that's only the case in a perfect hedge. Problem is, because of what's been going on in the Middle East, we have had a far from perfect market. So unfortunately, the market has not been perfect and it has been distorted. And so what we're seeing is that instead of the hedges following in parallel with the benchmark prices, there's been distortion. And this can be caused by various different problems. This this difference is known as basis risk. And if you're talking about hedging, you'll hear about basis risk. But I've given you one example here. And what we've seen is that the market has been in very steep backwardation. That means that the prices for prompt delivery, so a delivery of a cargo today, is worth more than delivery in the future. Now, in order to protect yourself against market movement, you must keep your hedge in place until you fix the price of your sale. So you don't know when that's going to be. You may have loaded a cargo in April and it may not still have discharged. You may have taken out your hedge expecting it to discharge in May and it hasn't. So you have to what's known as roll the hedge, which means that you buy it back and then you sell it for a future in the future. And the problem is, because of a backwardated market, you're buying it back at a higher price than you're selling it forward. And so you're losing money. So that is one of the reasons that there's imperfections in here. Nevertheless, most traders will be managing their price risk in the way that I've been talking about. So in answer to your question, yes, it is possible to manage the price risk, but it's not perfect. And the important thing to remember is that in the example I gave before, where you've lost $10 a barrel on a 1 million or 2 million barrel cargo, you may have lost 10 million, 20 million on the physical. You could well have recouped 90% of that. So you're actually only losing 1 or 2 million barrels. And that's the real loss to the trader. And I only just mentioned this, that I was looking at this and trying to find a comparison. And the comparison that I found was when we had the attacks by the Houthis back in last year, which seems a long time ago now. And the shipping attacks effectively closed the entrance to the Red Sea. I don't know if we want to go back to the slide that I had before.
Testing my skills.
I know. There we go. So we've got down here, the Bab el-Mandeb entrance to the Red Sea, and it effectively closed it. And then there was a ceasefire that happened in November of last year. And what was interesting is when the ceasefire happened, there wasn't a sudden rush of ships that started to go through there. Even 100 days after the ceasefire, the traffic was still only 60% of what it had been before. But then I thought, hold on a minute, this is a different situation, because here you had an alternative route. You could send your ships around the Cape. We don't have that in the Middle East. So therefore, the potential opening up of the Strait of Hormuz, one would expect many more ships will suddenly start to go through if they can. So that was just something I was just going to throw in as a thought.
Okay, so we're still doing okay on time with those extra 2 minutes. So we are on the back to the list of topics. We're now on to the third and final one, the Mercuria Baltic Exchange litigation. What I'm proposing to do on this is to ask you first, Ed, if you could summarize the position taken by Mercuria and the legal arguments from their perspective. And then once Ed has done that, Rebecca, you can provide the alternative position. And once that's been done, we may open it to the floor to see what kind of the sentiment is out there. And I may or may not have a plant in the audience who knows about this kind of stuff. Alan. So, Ed.
Thanks, Jonathan. Ladies and gentlemen, the adage last but not least springs to mind, because thank you for staying with us. This, albeit third topic, is crucial because it's the first major litigation that's arisen out of epic fury. And actually the issues are extremely important in our industry. And the key issue is this: how should a benchmark administrator like the Baltic Exchange respond when the physical market underlying that very benchmark
effectively ceases to exist? Well, we've seen that vessels on the dark side, or a few vessels crept out, but to all intents and purposes, from the beginning, I say on behalf of Mercuria, of Operation Epic Fury, the benchmark effectively should properly cease to exist, because it wasn't reliable passage. So at the heart of the issue then, in that context, is did Baltic Exchange exercise the minimum skill and care to be expected of a benchmark administrator? And we need to keep in mind that the Baltic, in its own words, on its own admission, is the world's only independent source of maritime market information for the trading and settlement of physical and derivative contracts. So they set up their stall, the world's only. So is it unsurprising that reliance will be placed? Now, we are concerned here with one benchmark, one specific benchmark. And it is this: the TD3C benchmark is the crucial measure for VLCCs, passing and measured from Ras Tanura in Saudi Arabia, which is well within the AG, as everybody knows, to Ningbo in China. And that is the crucial voyage that underlies this market measure, which will be responsible for settling freight contracts and derivative positions. Now, the claimant's position, then, you'll see, unsurprisingly, out of what I've said, is that the TD3C, which is the only benchmark that we're concerned with, the TD3C benchmark no longer reflects the market, clearly no longer reflects the economic reality of that voyage. Ras Tanura is embedded in the Gulf. You can't get from Ras Tanura to China without passing through the Straits of Hormuz. In order to pass through the Straits of Hormuz, it's well, I mean, we've seen in the seminar, it's fraught with danger and difficulties, and the underlying market has essentially fallen away. So on that basis, Mercuria seeks three declarations that the benchmark should be determined on comparable routes. Put at its simplest, the position is this: what could have been easier than at the beginning of Epic Fury, than Baltic to suck their teeth and say, well, this isn't great. Ras Tanura is bedded in the AG. Why don't we use a port that's outside the Gulf, and just to adjust the benchmarking from that, because from there to China should, or at least in real terms, be largely unaffected. And there is a basis for this, because on the 4th of March 2026, if my maths isn't wrong, around a week after the beginning of Epic Fury, the Baltic did indeed change one of their key other Middle East benchmarks. Forgive me, I think it's the BLP G1. Is that right? I think that's right. Which is a separate Middle Eastern benchmark. So why not TD3C as the key VLCC benchmark measure? Instead, Mercuria maintain that any investigation or inquiry was only launched by the Baltic on the 20th of April 2026, and then only after the formal declaration of closure, such as it is, by the IRGC. So again, unless my maths is badly out of sync, that's circa 7 weeks after the commencement of Epic Fury, that Baltic made any kind of consideration. And to do justice to Mercuria's position, and I'll keep it fairly brief, but it's only right that I say a few words about the legal basis for their claim for these declarations that we've been discussing. They put their claim on the basis of the regulation EU 2016-1011, which, like a lot of legislation, was assimilated into UK law by the European Union Withdrawal Act of 2018, obviously just after we left the EU. Now, I've just cherry-picked, because obviously time doesn't allow, and I need to allow ample time for Rebecca to forcefully put her case. So forgive me, I've cherry-picked just 2 or 3 out of this. Article 11 requires benchmark and benchmark administrators to be basing their analysis on input data which represents accurately and reliably the market or economic reality that the benchmark is intended to measure. Well, that can't be right. The market fell through the floor. There was no market. Article 11.4 obliges benchmark administrators, to change and update data which no longer reflect the reality or the market, or, and this is key, cease to provide the benchmark. So in other words, why not use Corfracan or Fujera? Or if you're really troubled, what they should properly have done, which is the alternative case, actually cease to provide that benchmark. The Baltic's own guide to market benchmarks rehearses the need to change or suspend benchmarks due to market change. Well, hello. They didn't even respond for 7 weeks. The Baltic's secondary liability, or Mercuria put their alternative position on a contractual basis, which arises out of the terms and conditions which of Mercuria being a member of the Baltic Exchange, and that the legal burden is this, that the Baltic is required to exercise the skill and care which may be expected of a provider of such services under the terms and conditions. So forgive me, it's a little bit rushed, but I've cherry-picked some of the key articles and obligations that Mercuria say that the Baltic Exchange should have honoured or adhered to. Rebecca.
Thank you very much. So along with it being the most significant, particularly public dispute that has happened since the commencement of Operation Epic Fury, it's also one where we should have a resolution of sorts potentially by the end of this year. The hearing has been expedited and is set for 15 days in October. And that is on the basis that it is hoped that there will be a judgment that can be handed down by the end of the year or potentially in the first term of next year. So it's very hot, it's very current, and there is clearly a lot of public interest. So on behalf of the Baltic, there are 2 main sections of their defence. The first is a threshold defence, and the second is the substantive defence. So the threshold defences are, even if the Baltic was in breach of its obligations under the benchmark regulation or under the terms, Mercuria's claim is barred in its entirety because there's a limitation of liability under the terms, and under the benchmark regulation, Articles 11 and 12 that Ed has spoken about are not actionable by way of a private law claim. The limitation point is that Mercuria's, under the contract that it has with the Baltic, is limited to making a claim in damages, and that's under clause 6.9. What they're seeking here is a declaration or 3 declarations, and therefore that is excluded under the terms. The reasonableness, UCTA reasonableness of this exclusion clause doesn't apply here. It's not an answer because the Baltic provides services to a large number of market participants. Allowing any claim on that basis brings uncertainty and affects the Baltic's ability to provide its services to all of those market participants. On the benchmark regulation point, the Baltic says that it's subject to regulatory oversight by the FCA. An aggrieved market participant has recourse to the FCA, who will then investigate. If that market participant is then dissatisfied with the outcome following that investigation, they can bring a judicial review of that decision. On the non-actionability under the benchmark regulations, the articles don't confer a private right of action on private parties. It's not explicit, it's not implicit in those articles. And again, the FCA has the comprehensive enforcement regime. Under the benchmark regulation, TD3C is known as a non-significant benchmark. It is significant to those market participants who use it, but within the meaning of the regulation, it's non-significant. And so as a result, it has a reduced and less onerous regime. The obligations on it, which the Baltic would say it does and goes over what it is obliged to do, are to select a reliable and representative panel, draw up and publish clear guidelines for those panelists, and it's the panelists who provide the data that is collated in order to make the benchmark, and then to evaluate and verify that input data and to take steps if following that verification, the Baltic itself considers that the data doesn't represent the market or the economic reality that the benchmark was intended to measure. Those are the obligations, and it says that it fulfilled those obligations, but also there is no right to make a claim as a private party. Going to the substantive defences, again, this is, as Ed did, is a rush through the sort of the headline points, but they are as follows. The Baltics continued to publish the TD3C benchmark route. It's based on a forward-looking assessment of the market by a number of panelists. Those panelists themselves are all reputable shipbrokers. The fact of no voyages going through on that day that they are asked to make this prospective assessment doesn't make a difference. It's a forward-looking assessment. It continues, they say, to be a route that is capable of assessment, and that is something that they are checking with their panelists. To answer the point about the other benchmark that did change, the change there was a change in the schedule. It went from a weekly to a bi-weekly publishing, and that was after a consultation with the panelists. So the Baltic would say that that is not a comparable situation. They will say that lawful passage of the strait is and has been possible, and there are a number of vessels that are making the crossing. Remains to be seen, but I would say that a judicial finding on this in whenever we get this judgment will have obvious implications for anyone who's looking to make any claim related to the current crisis, whichever way the court makes a finding. The next point is that the Baltic has provided clear guidance in relation to the determination of the benchmark, has evaluated the data, has considered whether the benchmark should be published, and it has been done with reasonable care and skill. Even if it is actionable under the benchmark regulation, the conclusion need not be the only conclusion. It need not be the best conclusion, but it needs to be something that they have evaluated, and that's the obligation on them, and they have satisfied that obligation. They then ask the court to exercise its discretion in the alternative or in addition. Even if a breach were to be established, the court should exercise discretion and refuse declaratory relief, because the declaration that it wants is to restate the benchmark for all of the relevant period. But if the court were to make such an order, that benchmark is so widely used that a restatement would cause significant disruption throughout the industry. And then finally, again, something that is said against the Baltic, but they carried out a consultation in April of 2026, and 55% of the respondents, so a majority, voted against changing the methodology. And that is the case in a nutshell.
And alas, we have no determination, so we
We
can't
also-
conclude with that.
We also have no access to the reply, which has been filed but is not currently available.
Not yet available. What I was thinking I might do now is slightly unorthodox in the sense that, do you have the microphone? Will we pass one to Mr. Ward over here? So just we have the benefit of one of our fellow partners here at SH, who is a regulatory specialist, and amazing though the panelists are, I don't think they identify themselves as specialists in regulation and regulatory litigation. So Alan, and for everyone in the room, you may be aware, a few years ago, there was substantial LME litigation where, as a result of huge disruption in that market, the LME cancelled trades, and that resulted in certain market participants seeking to challenge the decisions of the LME in cancelling those trades. There are at least some superficial similarities between that case and what we have here. So I was just wondering, in general terms, Alan, are there parallels that can be drawn, or if there are, what are the limits of those? Is it for the room, or is it just for online?
Is that working now? There we go.
Yeah.
Amazingly, you need to switch it on. So the case Jonathan referenced, LME and Elliott, Jane Street, was also a claimant, but I'll call it Elliott for shorthand, was a case very similar, as Jonathan says, superficially to this one. And you can draw from it some parallels, and you can maybe, I say, draw from it some thoughts and conclusions about where the Mercuria claim might go, because I think fundamentally the courts will approach the questions similarly. So LME, as you know, and Elliott was about the nickel price spike. This was March of 2022. Nickel prices, you'll remember, after the Ukraine war, again, a similarity here, a generational conflict leading to market disruption. Nickel prices go up by between 250 and 400% over a 3-day period. LME calls this a disorderly market and cancels $12 billion of trades. And that creates a big class of losers and a big class of winners. And again, we have there a similarity, factually, with Mercuria and Baltic Exchange. The main difference between the claim that Elliott brought against the exchange and this one we're talking about, Mercuria, is the legal foundation of it. And legally, they're chalk and cheese. The LME case was a judicial review. The question the court was asked is the decision made by the exchange a reasonable one, applying the legal definition of reasonable, which is an incredibly high threshold. And in this case, Mercuria, perhaps because Elliott were unsuccessful, and perhaps because Mercuria learned a lesson from that, what we have is a commercial court claim. And in the commercial court, evidence is going to be crucial. The question of whether the strait was open or not is going to be a matter of debate and evidence. It's been a matter of debate this evening already. So there's the key foundational legal difference. The similarities are perhaps obvious. I've touched on them already. You have a big class of winners and losers. The losers are dissatisfied with we call it quasi-regulatory decision, a decision made by a market infrastructure provider, to use non-technical language, an exchange on the one hand, a benchmark provider on the other. The main similarity, I think, and this is the key point, is what the claimants in both cases were, and in this case are asking. And in the Mercuria case, I think one of the biggest challenges is, as it was for LME, that the claimant is asking the court to step into the shoes of the regulator, to effectively discharge what is a regulatory function very directly in the Mercuria case in respect of a regulation. And the claimant is saying, you, the court, not the FCA, should be the one to enforce the benchmark regulation. And that is a challenging, in my personal opinion, submission. More fundamentally still, again, a similarity between both cases, which might, I think, give us a clue as to potential outcome, is that in the Mercuria case, just as in LME, what the claimant is asking the court to do is really reconstitute an entire market. And that, in my experience of many like cases, not just LME, is something the court will be incredibly reluctant to do. But I very much welcome other perspectives and opinions.
Well, that kind of leads me on, actually, because I think I was planning on ending this point by asking for a show of hands. of just the sentiment in the room as to whether, I mean, and this isn't, I'm not asking for in a show of hands on the basis of legal analysis, just on sentiment of whether this is, in fact, the kind of situation in which the court should be intervening, or whether it really ought to be a matter for the regulator. So, who thinks the court should be? And I have expressly no view. I'm a moderator. I'm not a loud one.
The camera's only on the panel, so
well, we can express to those online what it looks like. But so, show of hands in the room, who thinks instinctively that this is a matter for the court rather than the regulator? A distinct minority by the looks of it. And you're not allowed to have no view. You have to have one view or the other. So the other way around then, who thinks that what I just said, the matter of the court. Yeah, who thinks it's for the regulator? Okay. That's a pretty compelling finding in favor. Maybe we should let the court know that we've already decided. A pretty compelling finding in favor of the regulator. We are a shade past past. There is a provision for Q&A. I don't know if we want to allow a little bit of time for that now. Maybe I don't see anything online, but if there are any questions anyone wants to type in online, do so before we break. And then on the floor here, any questions? Oh, Mr. McHugh, I knew you'd have one. No pub quiz questions, please.
Hi. Just Ed and Rebecca, you were talking about how, this is going all the way back to the first topic, how the clauses in charter parties are not fit for purpose because of what's been unleashed by Epic. I was going to say something else beginning with an F, but Epic Fury. Why is that when we've had situations like this before, like Ukraine, when ships were trapped, or indeed in Iran-Iraq, when ships were trapped in the Persian Gulf in a similar way? Why was it not taken care of then, do we think? Appreciate that you're not BIMCO.
Yeah, I think that there was some justification for certainly the convoy position of the reasonable judgment of the master being sort of relatively binary. Viz, is it safe for me to proceed or not? Obviously, what belies that in no small part is the SOLAS obligations that he has in relation to the safety of the vessel and the crew. And in previous conflicts, we haven't perhaps seen anything like the fluidity and the dynamic nature. Well, I mean, we were saying at the beginning, we woke up this morning to different news, and so that's an element of it. I don't want to. I mean, they did an excellent job in the clausing before, but they were looking, and as I said, they're very much looking at alternative routing and APs as well. But I would say they didn't have to give their mind to that sort of dynamic reassessment and the attendant losses of time. And as I said, slow steaming, waiting offshore, updated intelligence, that sort of stuff had never, it was never really center stage previously. Rebecca, maybe you have some comments.
Yeah, no, I'd agree with that. And just also add, so I think there's one point, which is the drafting is done by committee, and I think can't be done quickly. So that feeds into it. With any contractual relationship, obviously it's two parties. You're never going to be able to agree the perfect clause for whichever party you are. But also here, the unusual nature of the strait, which there was always a theoretical chance that it could have been closed, but it was actually closed, or maybe it wasn't. Who knows? To be discussed. But the fact of everyone being trapped and there being no alternative route is a different situation to ones that we've had before, where vessels were stuck following the Russia-Ukraine war. That was a different thing, because it was the hostilities themselves that made them stuck there. They were sort of incidental to the conflict, whereas this situation, Iran specifically was trying to disrupt global trade, and that is a sort of an act on everyone else, which we haven't really experienced before, and wasn't necessarily contemplated when the sort of various drafting committees were meeting before.
I think so. I mean, the Houthis were obviously trying to disrupt world trade rather successfully, but the routing around South Africa was obviously a formula. And so I would agree with what Rebecca says as well, is that, this has put the world in a, unenviable, unique position. And the parties are going to need to react to that.
It was over there first, or I don't know, whoever can claim.
It's on. Not as a spokesman for BIMCO, but I don't get why things are thought to have changed so dramatically, in that the clause used to deal expressly and separately with blockades. And in effect, even if not in the international law of war, what's happened to the Strait of Hormuz is a blockade. And one part of what's happened has been an official law of war blockade by the United States against Iranian ports. It's just, as I understand it, that the BIMCO clause doesn't make any express provision for dealing with waiting time beyond 48 hours. How big a deal is that?
Well, I mean, arguably, it's rather more than that. Although obviously, it's 72 hours, isn't it, under the 25 version? It throws into stark relief. Is it a blockade? So let's take ourselves to today's position. In fact, before we do, let's look at the original position. There was, in the evidence of Baltic against Mercuria, a lot of vessels passing. I mean, in the evidence given, there were 40 or 50 vessels in the early April proceeding. But what we do know is that the majority of vessels were well over 20 years old. They had no IAX or IG cover. And they may well have been sanctioned vessels in the shadow fleet, but there were vessels passing. And now if we look at today's position, it's definitely not is it a blockade? I mean, every day it's different, obviously, but vessels can go. And in fact, sorry, forgive me, I think I may have mentioned earlier, I mean, the Ever Lovely obviously was struck by hugging the Omani coast, but the press that I've read over the last 2 days is that actually there are a lot of vessels that have gone out that way, which is an interesting dynamic, because arguably the Iranians are losing that leverage because they're letting that happen. And a lot of container vessel movements is something very interesting. I think that's potentially a game changer. And a lot of vessels coming in now. And in fact, yesterday, according to the stats that I read, the numbers of vessels coming in were more than double those going out. So that's not a blockade to me. And I think that's maybe the environment that we're in. It's very stop-start. And so that's why I think, there is a need for careful consideration. I don't know whether you agree with that, Rebecca.
I do agree. I don't think I have anything to add to that particularly. I'm also a bit conscious of keeping everyone from a drink outside.
Yeah.
But do you want to last that?
Yeah. Has everyone got tolerance for one more, if there is one more question? Which I think there's a question waiting.
Hi, thank you. I'm from Control Risks, so this is a very unlawyerly question. But in addition to everything else that's unprecedented about this crisis, one of the peculiar factors is the Trump factor, and specifically, I mean, companies understatement of the year. Specifically, companies making either go or no-go decisions on the basis of statements by Trump or even U.S. military authorities, despite the fact that they were kind of blatantly either kind of just out and out false or misinterpretations of what the Iranians were saying. I know we were dealing with many of those companies basically saying, it's not true, don't go, the risk hasn't changed. But I wonder how that will factor into all of the subsequent disputes that yourselves and everyone else in this room will be kind of dealing with. Thanks.
Who wants to take that?
I mean, it will definitely factor in, and it's one of those points that is going to give a very annoying answer, which to say it does depend on the clause that you're looking to dispute under, because some of them will be very strict, very narrowly construed. Some of them will be pretty wide, and something that is said by Trump to have been allowing vessels to go through, that could in some circumstances be enough to render the strait open, even though it wasn't in fact open to sort of safe passage. So I think it depends basically, which is a really annoying answer, but it's definitely it's ripe for a lot of dispute, and the contemporaneous evidence at the time will be really important.
I think that's a really important point, the fact that it's got to be contemporaneous, because it's so easy to look at the situation in hindsight. And we've learnt that what Trump says is often blatantly untrue. But at the time, we may have believed it more. It may have been more credible at the time. So I think it's going to be really important to look at the situation at the time, what was believed at the time.
And I think also there's quite a few of these clauses that do give a little bit of discretion to the parties. And so as well as what was actually happening at the time and what the actual risk may or may not have been, it will be important to look at what the parties understood that risk to be as well. And ideally they would be talking about that on email and telling each other why they're not going. But that, yeah.
Okay, so I'm very close to letting everyone go outside for a drink. If I have got this correctly, and I hope I've got this correct, because otherwise I'm putting Francesca on the spot. But I think Francesca Kappa is going to say some concluding words, if I've got that right. But before I let her do so, because she may be thanking people, and she can't thank herself. So I'd like to say thank you very much to Francesca Kappa for helping put everything together, and for her efforts in making the arrangements for today, which I think has been a success, and I hope it has. Francesca?
Hi, thank you, everyone. Can you hear me?
Yeah.
Okay, so thank you very much. So I would like to say, first of all, on behalf of the LSLC, YMP, thank you, Jonathan, Rebecca, and all at SH for hosting today's event, and really to each of today's speakers for their tremendous efforts in preparing this extremely interested, well-attended, and highly topical event. It is clearly a wide-ranging and far-reaching topic, and I thought that the structure in which the speaker presented really made the issue very clear and the information digestible. Thank you for bringing us literally up to the second on this topic, which I know has been generating many interesting issues and challenges across the shipping, insurance, and trading industry, not to mention some very late night that I'm sure many of you have been living with for the last months, especially for the fertilizers and oil sectors. And I mean, while obviously this is all very interesting and challenging for many of us professional, one of the thoughts I had is that I really would like also to remember for all of us, the seafarers, because many of them in the past months have dedicated themselves to keeping essential trade moving despite the personal risks, the challenges, and the discomfort that has entailed. And I think we all very much hope for a long-lasting peace, given the human cost of the conflict on all sides. So I just thought that I would mention that, because sometimes, of course, we all think about the cases and the vessels, but there is also the human elements, and many of us and the clubs were constantly in contact with vessel transiting and masters having to take decision, and I thought that was quite important. And finally, I would also like to take the opportunity to thank Gerard for his tremendous help in putting today's event together. And of course, Dr. Aleka Shepard for her input, endless enthusiasm and energy, which has led to today's event. And last not least, our audience, I mean, both online and in person. I think we had over 200 people signing up and many attending from different parts of the world, even with different time zone. Thank you, Dhruv, for attending from Singapore. And I know that some of my colleagues also attended, are attending even if it's very late in Asia. So thank you, everyone, and I wish you all a very nice evening.